All right, the day that was Monday, October 6th, 2000 tick chart NQ. Some of the analysis that I did to begin the day, we can see the prior day value area over here and the overnight value area over here. And what you'll notice is that the overnight value area had shifted up from the prior day, giving us a little bit of a bullish bias. So ideally what I'd want to look for, or you'd want to look for, is like a light retrace into the prior day value area. You don't want to see it like just take off because already this is pretty thin volume. You want to see it retrace into the prior day value area and then take off, right? Give it a little bit of juice before it takes off. There were a few. All that to say, I mean, if for whatever reason you really wanted to play the short card, there were a few rotation-based shorts from that you could have taken from the value area high back down to the point of control. You can see that over here we lost the value area high and rotated back to the POC and ping pong and that sort of thing. But the main play was going long, and we're at all-time highs. The market doesn't seem to want to stop, so why fight that? So here you can see price did retrace to the point of control, and right here would have been the ideal long, and I got in super late, too late, way too late. I thought to myself, well, now that we got the retrace to the point of control, maybe that's the juice that it needs to go back to all-time highs, or go back to the high of the overnight value area, or the overnight high. I got in too late, and in my mind, this is the thinking that was happening in my mind. Now that I thought to myself, okay, well, bounce off the POC, reclaim of the value area high, so for sure it's basically going to just take off at this point, and I was wrong. I have to learn that I am not a breakout trader. I can only take trades. Let me just print the volume profile. At the bottom edge of a volume profile, you can see that very nicely defined volume profile down here at the bottom. This is where, at the very most, this is where I should have taken this trade. And had I done that, it would have been a nice 1-to-2 risk-reward ratio, right? Had I got this bounce off the POC and entered right on this candle, stop below, this would have been a nice 30-point trade with targeting the value area high. It would have been like a textbook AMT auction market theory play with sort of these value area rotations. And I just have to, if I get in late, or if I'm about to jump in, I just have to remind myself that I'm too late, and I need to just wait for the next time it rotates, or the next time it makes its way to back down to the bottom edge of a high volume node. It'll probably be about 30 minutes, and lo and behold, look what happened right over here. It rotated back down, hit the point of control again, and it absolutely took off. I don't know if I was sleeping or just not paying attention, but I didn't take this trade, unfortunately. If you did, that's what a trade that was, because price didn't really look back from that point. The things that gave this particular trade going long here more weight was the bounce off the point of control. But let me just kind of throw on a few order flow indicators just to show you what was happening behind the scenes. This was awesome. So look at this. You had some, what these bubbles basically show us is aggressive. So market orders, market participants clicking the button, so to speak, to, in this case, sell. So red bubble means someone went in and sold, I think, more than 100 contracts. It's a big order. And that also created a stacked imbalance. So stacked imbalance is basically just a way of saying sellers dominated. You'd have to zoom in. Let me just show you. Can I zoom in here? Yeah, so sellers dominated levels over here, and it basically prints this line on the levels, or the price levels, that they dominated. But what happens if you have people that are late to the party that don't get what they're looking for, which is more downside. Well, they basically have to cover their short, and that short covering, which is basically going long to close your position, fuels the leg higher. That's what happened here. What a beautiful trade. That was the trade of the day again that I missed. I said to myself, I'll just wait for it, and then, I don't know, whatever. We can't get them all. Let me get rid of big trades again, just because it's a little bit distracting. And stacked imbalances, we'll put them back in just a second. Let me reprint the volume profile and just show you what happened. Now, back in the pre-market, you'll notice that the overnight action started creating this volume profile that didn't really get, it started creating this high volume node that didn't really get too established. And once the market made its way back into that profile, or back into that high volume node, it started to build value. And what I did was I waited for a little retrace back into the lower edge of that high volume node to go long, targeting not the high of day, which I should have done, but basically I just targeted like this. I was basically just targeting like the top edge of this high volume node. I wasn't being greedy. I should have actually targeted the high, but I wasn't being greedy. I just said, okay, let me take what I can get, which would be the upper edge of this high volume node. Now, what actually ended up happening is that was my target. Price ended up retracing, and I took another contract over here because I was pretty confident that I would at least get this push higher. What made me confident with adding another contract? So I didn't average down. I actually got it more or less at the same price. But what made me confident was again, I was catching the move at the lower edge of the high volume node to go long. So I'm well positioned just from an order flow perspective. What you'll also notice if I just throw big trades back on is that you have all these late sellers over here that are trying to push price lower on each one of these candles and basically not really getting much return. And you can see that through cumulative volume delta here. So CVD is this indicator that's sometimes counterintuitive. You almost have to look at it upside down to kind of understand, or it requires interpretation, I guess is my point. So CVD basically shows us the delta between aggressive buyers and aggressive sellers. So you might automatically say to yourself, okay, well, I just need to look at CVD, and if it's going down, price should go down too. But it doesn't work exactly like that. In some circumstances, if you see aggressive selling and no follow through, so CVD is going down but price is staying flat, that tells you that sellers are getting absorbed. So there's some hidden passive buyer that's keeping price up at this level. And then it becomes just sort of a matter of time before aggressive selling dries up, and then you'll get this nice price movement, which I got over here. So this wasn't as big of a trade. The risk reward profile was nice. I think it was a little bit more than 2-to-1, but the trade itself wasn't as big as what I was hoping for. But because I added a second contract at my entry, it put me into the green. So I don't know. Take from that what you want. But that was the day. Oh, the other thing that I wanted to show you about this trade that I missed is if we just bring up a higher time frame chart, because I always keep my eye out on the 30-minute chart. So each one of these guys is a 30-minute candle. That POC, that second bounce off the POC, was this candle here. Look at how beautiful this candle is. So it bounces off the POC. You get this, again, that stacked imbalance. So the red line is the stacked imbalance line. Turn that off. You get I have another indicator that basically shows you absorption, which is implied from the stacked imbalance. And then you have this I think the trades filter is a minimum of 150 contracts that's showing here. So you have these three absorb, like, let's think of all the confluence here. We have a bounce off the POC. You have big trades coming in, absorption and stacked imbalance, and to add to that, just good old fashioned price action where you have this bullish hammer candle. I mean, had you just been looking at this alone on this candle, like, check this out, what you could have done, I could have done, you could have done. You just do this, right? Just a really simple, hey, bullish hammer candle, do a 2-to-1. All the way up there. Do we get it? Yep, we get it. What a beautiful trade. Just a simple, beautiful trade that would have been just based on looking at a 30-minute price chart. So anyway, all that to say, it's important to look at the higher time frame to guide you. That's another sort of thing that I have to always keep in my peripheral vision. Once I saw that coming in, the probability of this reversing off of all of these different confluences is pretty low. So, from 150, from 25, 150 onwards, you could have pretty much just pressed the long and made money. Anyway, that was the day. Take it easy.